Hello friends, this is Raman at tradingwithvenus.com. Today I wanted to share with you an example of a very good trade that sets up occasionally and how you can profitably take this trade, where your stop loss needs to be, how the trade generally plays out, and where you'd be looking to take your profits. This type of setup is called trading a market inefficiency or a gap. So let's go on to the charts and take a look. Here we have US dollar CAD 15-minute chart. As we can see here, this is the close of the price on Friday. And when the market opened on Sunday here, we saw the price jump up. And the move here was from the bottom to the top was about 180 pips in total. So that was the gap that happened. Price closed at the bottom on Friday, and when the markets opened on Sunday, the price had jumped up here. The highest level that it went to was about 150 pip, and the actual gap at the open was about 136 pips. So there was a big jump in price when the markets opened. A lot of different reasons can come behind why this move happens. This time it was around the price of oil. Russia and OPEC countries were supposed to meet in Doha, and they were supposed to come to an agreement on cutting oil production, which of course did not happen. And because that did not happen, US dollar went up against the Canadian dollar in quite a big move here. So how do you take advantage of this type of a gap that gets created in the market? Let's take a look. So the general idea is that when there's a move up like this, a gap in the market, price will come in and fill the gap. So that's what we're looking for, price to come back in and fill the gap. Before that happens, we have to look for a setup. So we don't want to take a short trade here, assuming that the gap will get filled, because generally there is another move to the upside in the same direction that the gap happened before the price actually turns around and comes back. So what we would be looking for is some sort of a reversal pattern. And in this case, what we have is a double top here. And another confluence here that we're looking for is it's 1.2988, so which is very close to the 1.30 level, so big figure. And it's also R2 if you trade pivot points. So this is a very good level, that support and resistance level. There's a double top pattern, reversal pattern. So we wait for this double top to happen, second part of the double top to happen, or the reversal pattern to happen. And then on the pullback, we take an entry short. And your stop loss would go above the high, the previous high here, and you're looking for price to come back in and fill the gap. As we can see here, price came back in, and once you get this green candle, which is again a reversal pattern here, you would get out of the trade. So in this trade, there was about 156 pips from entry to exit. Overall, the move was about 180 pips. So a nice amount of profit in the trade. So this is a quick example of how you would trade market gaps and inefficiencies. If you would like to learn more profitable Forex trading strategies, I invite you to visit my website, tradingwithvenus.com/Forex course. So that's all for today. I will see you next time.